For the first time in over a decade, Nvidia trades at the same forward earnings multiple as the average S&P 500 company, not at a modest discount to its own history, at parity with the index. Goldman Sachs flagged this in a trading note, noting it ended a 13-year streak of premium valuation that began in February 2013. The streak survived the 2018 crypto bust, the 2020 pandemic crash, and the 2022 rate shock. It did not survive the Iran war. That framing sounds like a macro story. It is not. The macro pressure triggered the reset, but the reset exposed something that was already building underneath, a fundamental disagreement about what Nvidia's earnings trajectory is actually worth. Here is the paradox in full. Analysts project Nvidia's earnings will grow roughly 70% in the current fiscal year. The company alone is expected to account for 21% of the entire S&P 500's earnings growth in 2026, yet the market is assigning that company no growth premium at all. In a rational framework, faster-growing companies command higher multiples. Nvidia has been growing faster than almost any company in history, and the multiple has collapsed to match the slowest-growing cohort in the index. The standard explanation is geopolitical risk and tariff uncertainty. That is real, but incomplete. The deeper explanation is that the market is not just discounting near-term headwinds. It is asking a harder question. What happens to Nvidia's earnings power if hyperscaler capital expenditure commitments slow, stall, or rotate toward custom silicon? That question did not have a clean answer until this week. On April 1st, Nvidia announced a $2 billion strategic investment in Marvell technology, paired with a deeper integration of its NVLink fusion architecture. On the surface, this reads as a straightforward ecosystem move. Nvidia invests in a partner, both companies benefit, the AI fabric expands. The stock jumped 5.6% on the day, its second-best session of the year. But the strategic logic runs deeper than that, and it is worth slowing down to understand why. Nvidia's largest customers, Amazon, Microsoft, Alphabet, Meta, are not stopping their GPU purchases. They are simultaneously building their own custom AI chips. Amazon works with Marvell on its Trainium and Graviton silicon. Alphabet and Meta are deepening relationships with Broadcom on custom accelerators. The conventional reading of this trend is bearish for Nvidia. If the hyperscalers build their own chips, they buy fewer GPUs. Market share erodes. The moat narrows. Nvidia's response with NVLink Fusion reframes the entire competitive dynamic. Rather than treating custom silicon as a threat to be defended against, Nvidia is opening its proprietary interconnect fabric so that custom chips can plug directly into the NVLink ecosystem. Marvell's chips can now connect to Nvidia's Grace Blackwell and Vera Rubin systems through the same fabric that links Nvidia GPUs to each other. The implication is structural. Nvidia is no longer competing against custom silicon. It is becoming the connective tissue that custom silicon runs through. Marvell's data center networking revenue reached $10.98 billion in the fourth quarter of fiscal 2026, up 263% year-over-year, driven specifically by NVLink ramp. That acceleration does not happen if customers are routing around Nvidia. It happens because customers are routing through Nvidia. Here is the point that most coverage has missed entirely. The Marvell investment is not primarily about Marvell's chip design capabilities. It is about Marvell's acquisition of Celestial AI, which added photonic fabric technology to Marvell's portfolio. Optical interconnects on the next bottleneck in AI infrastructure scaling. As GPU clusters grow from thousands to hundreds of thousands of chips, electrical interconnects hit physical limits. Photonics, moving data as light rather than electrons, is the architecture that unlocks the next generation of scale. By embedding Celestial AI's photonic fabric capabilities directly inside the NVLink ecosystem, Nvidia is positioning its networking architecture at the foundation of infrastructure that does not yet fully exist, but will become mandatory within the next 2 to 3 years.
The networking side of Nvidia's business is the piece that analysts have consistently underweighted. CUDA gets the attention, GPUs get the attention, but NVLink has quietly become a platform in its own right, one that third-party chipmakers are now paying to connect to rather than compete against. That changes the total addressable market calculus. Jensen Huang said it directly in the Marvell announcement. Together, the companies can address a much larger TAM. That is not promotional language. It is a description of a structural shift in how Nvidia monetizes AI infrastructure spend. Now, the reversal card. Every bear argument about Nvidia assumes the hyperscaler Capex cycle is the primary driver of demand. If Amazon, Microsoft, and Google slow their data center spending, Nvidia revenue falls. That has been the central thesis behind the multiple compression. But there is a second demand driver that is earlier in its cycle and currently underrepresented in analyst models. Enterprise adoption of AI agents is accelerating. Jensen Huang called it out explicitly on the Q4 fiscal 2026 earnings call. Enterprise adoption of agents is skyrocketing. This matters because enterprise AI workloads require inference infrastructure, not just training infrastructure. The first wave of AI capital spending was concentrated in a handful of hyperscalers buying massive training clusters. The next wave is distributed across thousands of enterprises deploying inference at scale. That wave has barely started, and the hardware it requires is different. Smaller, more specialized, more varied in its configuration. NVLink Fusion, by opening the fabric to custom and third-party silicon, makes NVIDIA's ecosystem the default platform for that distributed inference build-out. The risk is real and should not be minimized. Export controls on advanced chips continue to limit NVIDIA's access to the Chinese market, one of its largest historical revenue pools. Tariff uncertainty adds cost and complexity to supply chains that NVIDIA does not fully control. And the Marvell deal, however strategically coherent, does not immediately resolve the multiple compression driven by macro sentiment. If the Iran war sustains oil prices at elevated levels and forces the Fed toward tightening rather than easing, the valuation framework for all growth stocks shifts in ways that are not specific to NVIDIA. The scenario where the bear case holds is clear. Hyperscaler Capex commitments face pressure from slowing cloud growth or rising financing costs. Custom silicon adoption accelerates faster than NVLink Fusion can capture it. Export controls tighten further, cutting off addressable markets. In that combination, the current valuation reset does not represent a floor. It represents a transition to a structurally lower multiple regime. The recovery path, however, is also clearly defined. Evidence points toward a re-rating of NVIDIA's multiple, but only if two conditions hold simultaneously. First, enterprise AI agent deployment accelerates on a timeline that translates into measurable inference revenue within the next 2 fiscal quarters. Second, NVLink Fusion's ecosystem expansion, with Marvell, Arista, and Broadcom XPUs all connecting through NVIDIA's fabric, generates networking revenue growth that is visible and attributable in reported financials, not just in partnership announcements. If those two conditions materialize, the current price level represents a compression that is disconnected from the company's actual earnings trajectory. Analysts maintaining consensus targets in the range of 270 to 276 are essentially saying the gap between current price and fair value is the largest it has been since before the AI cycle began. That is a statement about the severity of the macro-driven dislocation, not about the fundamental business. What this week established is that NVIDIA's strategic response to the custom silicon threat is more sophisticated than building a better GPU. The company is engineering a gravitational field, a platform architecture so deeply embedded in the infrastructure layer that the question shifts from whether to use NVIDIA hardware to how much of NVIDIA's ecosystem to incorporate alongside custom alternatives. Power constraints, grid interconnection bottlenecks, and optical interconnect limitations are all problems NVIDIA is now funding solutions to, not waiting for others to solve. The valuation paradox may persist through macro uncertainty, but the strategic picture has become considerably clearer.